Welcome to today's video. First, let's set the stage. Many people believe meticulous budgeting will cure financial anxiety. However, even with discipline, stress often lingers because life is unpredictable and expensive. In this episode, we will unpack why that happens and, more importantly, what to do instead. We will challenge the idea that more tracking equals more peace and show you a more resilient way to measure financial success. Now, let's walk through the plan for today. Here is our roadmap. First, we will confront the uncomfortable truth about budgeting and anxiety. Next, we will explain why stress persists even when you are doing everything right. Then, we will introduce a mindset shift toward building a shock-ready financial system. After that, we will cover a practical setup you can put in place this month. We will then show you what to measure to feel more in control, followed by a couple of quizzes to lock in the ideas. Finally, we will summarize the key takeaways and next steps. Before we proceed, a quick disclaimer. This video is educational and does not constitute financial advice. Everyone's situation is different, so please consult a qualified professional for guidance tailored to your circumstances. With that established, let's move into the core truth. Here is the harsh truth. Budgeting is useful, but it does not cure financial anxiety. In fact, anxiety can persist because the root causes often come from outside your control, such as inflation, rent increases, and rising family costs. These factors can erode savings despite your best daily habits. Accepting that anxiety can be a rational response to macro forces is the first step toward building a better plan. Now, let's examine why the anxiety sticks around even when you're disciplined. Anxiety persists for several reasons. First, life is unpredictable, and macroeconomic forces such as inflation and rent hikes can overwhelm even well-crafted budgets. Second, budgets are primarily designed to manage recurring and predictable expenses. They are weaker against rare but large shocks, like a major home repair or medical bill. Third, paradoxically, stress can rise after you accumulate wealth, because the fear shifts from not having enough to the fear of losing what you have. This fear can create a psychological barrier where you hesitate to use the emergency fund or low-interest credit, even when it is appropriate. As you can see in the diagram, the cycle of control, shock, dip, and anxiety can repeat unless you design your system to absorb shocks by intent. With that context, let's shift the mindset. Here is the mindset shift. Rather than obsessing over daily tracking, evaluate the big picture regularly, your net worth trend, and your system's ability to absorb shocks. Redefine success as whether your plan handles crises without derailing your long-term goals. Use a rolling 12-month view to smooth out temporary dips and keep perspective. Construct purpose-built buckets, such as an emergency fund for true surprises, sinking funds for known future costs, and insurance to transfer catastrophic risks. Most importantly, give yourself explicit permission to use these assets as designed, without guilt or hesitation. Patience, planning, and discipline work together as a form of insurance against uncertainty. Next, let's translate this into concrete steps. To build a shock-ready system, start by setting emergency fund tiers. Establish a mini-fund of roughly 1 month of essential expenses, then a core fund covering 3 to 6 months, and a stretch target of 9 to 12 months if your income is volatile. Next, create sinking funds for known but irregular costs, such as home maintenance, auto repairs, deductibles, annual premiums, and travel. Third, right-size your insurance, including health coverage, renters or homeowners insurance, disability, term life, and possibly an umbrella policy if your risk warrants it. Fourth, use low-interest credit intentionally as a temporary bridge, and automate its paydown schedule to prevent drift. Fifth, automate transfers from your paycheck to the emergency fund, sinking funds, and investments to remove reliance on willpower. Sixth, schedule quarterly net worth reviews and an annual resilience check to assess your protection levels. Finally, reframe major expenses as system tests. Record each event, how it was absorbed, and what adjustment you made afterward. Now, let's quantify your targets. This table summarizes suggested buffer targets. For the emergency fund, begin with 1 month of essential expenses as a starter, progress to 3 to 6 months for a core buffer, and extend to 9 to 12 months if income is variable or responsibilities are higher. Sinking funds are set by each goal and timeline, such as home maintenance or annual premiums.
Ensure your insurance deductibles are fully covered by a dedicated reserve. For debt, automate minimum payments at a minimum, graduate to an aggressive paydown plan, and, at the stretch level, combine aggressive repayment with a cash cushion for flexibility. With targets in mind, let's compare two philosophies side by side. On the left, traditional budgeting emphasizes monthly categories and measuring adherence to rules, which can be fragile when large surprises occur. Success is defined as sticking to the plan, but anxiety often returns after a shock disrupts the categories. On the right, shock-ready planning focuses on buffers and risk transfer through insurance. It measures shock absorption and resilience, redefining success as the ability to cover crises while staying on track. Over time, as you see your system handle events, anxiety diminishes because your confidence is grounded in evidence. Now, to understand where stress really comes from, let's visualize the sources. This diagram will present a pie chart allocating stress sources among macroeconomic pressures, unpredictable one-off expenses, income volatility, and psychological fear of loss. The largest slice represents macro factors, such as inflation and rent increases. The next slice covers one-off shocks like major repairs. Income volatility forms another significant portion. Finally, the psychological component reflects how fear of using savings contributes to ongoing stress. Seeing these proportions highlights why control alone cannot eliminate anxiety. Next, let's test your understanding with a quick quiz. Quiz time. What is the most accurate way to define a budget's success in an uncertain world? Option A, perfectly matching monthly category targets. Option B, maintaining a zero-based plan every single week. Option C, absorbing financial shocks while net worth improves year over year. Option D, never touching the emergency fund. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video.
The correct answer is C. The most meaningful measure of success is whether your system can absorb shocks and still allow your net worth to improve year over year. Perfection in monthly categories is less important than resilience and progress over time. Now, let's refine how to measure that progress.
Shift your measurement system to resilience metrics. First, track your net worth quarterly and compare it year over year to see real progress. Second, monitor your cash runway, meaning the number of months of essential expenses you can cover with your accessible reserves. Third, keep a log of shock events and note which fund paid for them and how quickly you recovered. Fourth, calculate a rolling 12-month savings rate to smooth month-to-month volatility. Fifth, track your debt service ratio and automate paydowns to maintain control. Sixth, review insurance annually to ensure coverage remains appropriate and competitively priced. With measurement clarified, let's do one more quiz to reinforce the psychological piece. Second quiz. Which psychological barrier often increases after wealth accumulates? Option A, fear of budgeting categories. No. Option B, reluctance to deploy assets meant for protection. Option C, desire to overspend on lifestyle. Option D, aversion to automation. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video.
The correct answer is B. As wealth accumulates, the fear often shifts to a fear of loss, which can make you reluctant to use the very assets designed to protect you, like an emergency fund or low-interest credit. Recognizing this bias helps you use your system as intended.
Now, let's consolidate the most important points.
These are the key takeaways. Budgeting remains important, but it is not sufficient on its own. Define success by your ability to absorb shocks while your net worth rises. Build layered buffers through an emergency fund, sinking funds, and appropriate insurance.
Grant yourself permission to use protective assets when needed.
Maintain perspective with a rolling 12-month view. Above all, pursue progress over perfection, because resilience compounds over time. To close, let's visualize a simple timeline of handling shocks and still moving forward. This summary timeline shows that resilience grows as buffers and habits compound. Shocks occur periodically, but the system is designed to pass these tests. After each event, you rebuild and continue forward. Measuring year-over-year improvement provides a more meaningful signal than monthly perfection. Use each successful response to a crisis, even small ones, as evidence that you are on track.
Before we wrap, let's end with a quick thank you and a call to action.
Thank you for watching. If this video helped reframe your approach to money, please like the video, share it with someone who needs it, and subscribe for more calm and resilient financial strategies. In the comments, tell us about a time your system absorbed a shock and what you learned from it. Your story might be exactly what someone else needs to hear.